The first, let me bold this. CPA firm lawsuits with the client. If there's a lawsuit between the CPA and the client, that is an independence problem, or depending on the size of it, I guess. But CPA firm lawsuits with the client. So if the CPA firm is suing the client, or the client suing the CPA firm, or they're suing each other, that would generally be an independence problem. Second. Oops. Some more letters here. Lawsuits between clients. So easy, let's say that your clients are Microsoft and IBM. So let's say you have both Microsoft and IBM as clients, and I bet you money there's lawsuits between them. But so it could be between the CPA firm and the client. It could also be between clients. And between clients, because you got to remember too that you're looking at confidential information. And so to represent both of them, and if they're suing each other, that could be an independence problem, and that you have a fiduciary duty to your client, but now you have two of them, and you have a fiduciary duty to both of them that is equal. However, you may have information one way or another on the client. So if you have clients that are suing each other, it's possible you have an independence problem. You need to pick one of them. Okay. Non-test services, I am going to I'm going to skip this one for now. We're going to talk more about it later. I'll say C below. How about that? Okay, reporting illegal acts. Now, generally speaking, illegal acts, the only ones we're interested in, ones that are what? What type of illegal acts are we interested in? We report everything?
Material.
Excuse me. Just done that, I just spilled all over myself. Yeah, one of the things I do. Oh, by the way, and on the exams and on the CPA exam especially, if something the CPA exam does not require you to make the judgment call of whether something's material or not. But if they say it's material or it's immaterial, take it at that. So, like, on the first exam, I think it said something was immaterial, and you said, well, we have to test to see if it's immaterial. If it's given in the test, if it's given as immaterial, that's it. That's part of the facts that it's immaterial. Now what do you do? Or if it's material, it's material. Now what do you do? So don't. And so generally on CPA questions, don't disregard what they give you and don't add anything to it. So it's just kind of a quirk of the CPA exam is that they give you just enough information that you need, but don't add anything to it and don't take anything away from it. Okay, yeah, so we're only looking for material things when it comes to reporting illegal acts. So something that's immaterial, you generally don't have to report. There are some weird courts be dealing with government contracts, but that's a whole different scenario. So reporting illegal acts. Oops. Material illegal acts to upper management and board of directors and or audit committee. I think I told you the audit committee is just people who are on the board of directors. They're usually external directors. For publicly traded companies, they have to be external. So let me clean this up a little bit. So material illegal acts. Immaterial illegal acts we aren't required to do anything with. Or to upper management and the board of directors / audit committee, depending on publicly traded companies will have both. Privately held companies may or may not have an audit committee. Okay, now this is where it gets tricky. By the way, let's see here. A board of directors and audit committee, these are sometimes referred to as governance. I'm going to highlight that because that is a common term you'll see is reported to governance, and that's what they're talking about. Governance is generally the board of directors and or the audit committee. So they kind of link those together, and they're called governance. So if you see governance, that's what it's talking about. Okay. Board of directors / audit committee. Fails to act, then, okay, here's where it's a little different. So suppose you report this, if you find a material illegal act, you report to the board of directors and upper management, and they don't do anything with it. So you found this illegal act, they don't respond, or they don't respond in a way that you think is adequate to it. So you're gonna have two choices, and it depends on whether they're issuers or they're non-issuers. And we'll take issuers first. So issuers, so publicly traded companies. This is a material illegal act. So we reported to the Securities and Exchange Commission. I think my one hand is typing faster than the other one today. So illegal act should be reported to the Securities and Exchange Commission within 24 hours. So they have a pretty tight window that they have to do something about material illegal activity, illegal acts. So again, this is only for material acts. And you need to report it to the SEC if they don't have appropriate action within 24 hours. So that's a pretty short period of time. But you need to report to the Securities and Exchange Commission within 24 hours of learning of the illegal act, and I should say of informing the Board of Directors Audit Committee of the illegal act. And you need to do it within 24 hours or else you're going to be in trouble too. So, you know, and by the way, this is something you communicate to the client. Like, look, you guys got to do something meaningful in the next 24 hours about this, or else it goes to the Securities and Exchange Commission. And that's kind of what the Securities and Exchange Commission wants to do. They want to have companies act appropriately when they find illegal acts. So, you know, there's nothing secretive about that. It's either you do something meaningful or, you know, it's going to the Securities Exchange Commission. And that's not going to be fun. Okay. Now, if they are non-issuers, it's actually trickier. Non-issuers. And this seems kind of a cop-out, but this is what you have to do. Non-issuers are not regulated by the Securities and Exchange Commission, so you can't tell the Securities and Exchange Commission on non-issuers. You basically have to get legal advice. Oops. And it's one of those things that, you know, you may say, well, why don't they just go to, you know, the FBI or something like that? You actually have a duty, a fiduciary duty to the client. So if you're not an issuer, Securities and Exchange Commission doesn't come into play, they can't regulate non-issuers. So if they're doing an illegal act, you have to, because you have to know who or what do you contact. My you know, one of the things is that would be in your realm of possibilities would be withdrawing from the audit. That would certainly be one of them. But there's also this legal responsibility that you have as a CPA. You have a fiduciary duty to the clients, but you also have a duty to the public. And this will come up later too. You have a fiduciary duty to the public, basically to be a good citizen and to report things that are illegal. So you're really stuck in a hard place here because, yeah, you can walk away from the client. However, you do have this duty to the public, kind of like, you know, doctors and lawyers and other people have duties to the public that are beyond what normal people have. I'll give you an example that's definitely in the code, and that is if you're a licensed professional, that you have to report abuse to elderly people, abuse to children, and you have to do it immediately for both of those things. The general public, believe it or not, is not obligated to do that, but as a professional, you are. And so when you see those things, you are required, you lose your license if you don't report those things. So we're held to a higher standard, but it's part of that is to protect the public, and part of that is when there's illegal acts, what do you do? Excuse me, when you find out about these things. So walking away from the audit is one thing, but then there's also this professional code that you have to kind of live up to that protecting the public. So you need to get a lawyer to do it. And again, you know, it's for publicly traded companies, it's kind of nice. You just give it to the SEC and have them work it out. But for non-publicly traded companies, and you have a material illegal act, then you have a problem. You have competing duties, you know, to the public and to the client. Okay, subpoenas. So, okay. The audit work papers are owned by the CPA firm. So when you do an audit, does the client get the work papers? No, they are owned by the CPA firm. And the CPA firm owns those work papers to defend themselves in court. So you get all this information, you get your work papers, you put them all together. That is your evidence that if you get called into court, you're going to say, okay, no, we did this, and you have, the backup information. They do not get shared with the clients in general. There might be, you might give them information about if you find something wrong, and they say, okay, well, can we see what we need to do, that kind of thing. But as far as the work papers themselves, they are owned by the CPA firm. Now, just because the CPA firm owns them doesn't mean they can just the information. It's still confidential information. So they cannot share that confidential information without the approval of the client. Okay, so generally the CPA firm does not need to respond in a legal request except a valid subpoena. And by the way, it has to be a valid subpoena. It cannot be, a letter from a lawyer. So a CPA, so a subpoena, if there's a valid subpoena, now a subpoena means that that someone has to go to court and get a judge to agree that they should turn over this information. If there is a valid subpoena, you are required to turn over that information. Oops. Why did kick that out as a, I don't know. Okay, so it has to be a valid subpoena. And again, you may get inquiries from lawyers, background information, stuff like that. You just ignore it unless it's a subpoena. If they really need that information, they go to a judge, and the judge will say, yeah, you need to share this information with somebody suing your client or whatever it is. So only a valid subpoena coming from a court is allowed. And in some states, information is almost like being a lawyer with the CPA firm. Most states it's not. In some states it is. In some states they won't. CPA firms are generally not held even to subpoenas. The same way, if there's a criminal trial, the conversations between the defendant and their lawyer is protected. There's nothing you can do to find out what the information is between those two. In some states, between the CPA firm and the client, it's almost like that. But again, if there's a valid subpoena, you are required to turn over the information that is included in the subpoena. Okay. Okay, auditors uncover evidence that their publicly traded client is routinely violating the Environmental Protection Agency Act. When presented with the evidence, the client or management board of directors did not respond within 24 hours. Under this scenario, the client should do which of the following? Oh, come on, we just talked about it.
C?
Yep. And this is important, and I'll tell you why. The one thing you don't do, you say, well, I contact the FBI. No, you don't. You don't contact the FBI. You don't contact the EPA. You turn it over to the SEC. Let the SEC worry about it. But you do not contact law enforcement agencies or even agencies for federal agencies. You contact the SEC. The SEC will then determine what needs to be done. So you don't tell anybody except the SEC. It's their problem now. Okay, I need to get rid of the C below thing here. Okay. The auditors uncover evidence that a CEO of a publicly traded company client routinely parks his car illegally in handicapped parking spaces. So the evidence the client's over management did not respond within 24 hours. In this scenario, the client should do which of the following?
Would it be B, do nothing?
Yeah, it's very unlikely that this is going to be material. It's a rotten thing to do, but it's probably not going to be material to the financial statements. So most likely this would be do nothing. Yeah. So the kind of difference between these two, if they're violating federal laws and that they could have an impact on the financial statements. And not only that, and this is another kind of interesting thing that's decent. Oops, let's undo that. We'll say, oh, I know. Oops, no, don't do that. Isn't this fun watching me learn how to use a computer? Okay. One of the big things nowadays are these companies making what they call green statements. They'll say, oh, we're, and they give all this data about how green they are. Reporting it is kind of the Wild West. They don't have to have an audit report or anything saying that what they're saying is correct. Now, some of them do. These have become really big for some, sometimes for the corporate investors that they want to see these green statements. Then they say, well, wait a minute, how do we know that this stuff in the green statement is correct? How do we know they're not violating EPA rules and all this stuff? So sometimes they have people come in to audit them. Now, they can have a CPA firm do it. And CPA firms, we have standards that we can audit almost anything. So they can have CPA firms come in and do it, but they can also have just anybody come in and do it. And it's really wild when you see the difference between the two, because the CPA firms are very much, we tested this, we tested that, that kind of stuff. And we're not aware of any violations is basically what they kind of come up with if they don't find anything. The other ones are almost like, it's almost like marketing or cheerleading. They're the greenest company in the world, and blah blah blah. It's obviously that they're not. It's obviously they're biased. They're advocating for the client, which we can't do. You can't advocate for a client if you're in a CPA firm. So there's a very big difference in the audit reports between a CPA firm doing it and a non-CPA firm doing it. And there really hasn't been any. It's going to be interesting how this works out. How if when they start doing these audits of these green statements, how they're going to regulate that, because again, it's a Wild West. They could, it's just anything. You don't even know what they did. Looking at these financial statements and again, CPA firms, we have rules on how you perform audits of things that aren't financial statements, and that you get attestations and assurance and all that. but they don't need to be a CPA firm for these audits of green statements. It's pretty wild, and they're not, and the audit isn't required either. They can just say anything, and it pretty much goes unchallenged for the most part. Okay. Contingent fees. I'm going to take a little more time on this than first we expected. Okay. Let's see. It's not working. Okay. Okay, flat fees are always allowed by a CPA firm for any service. So charging a flat fee. So, you know, for example, whatever the service is, if you charge $16,000 for it, you know, that's absolutely fine. Contingent fees are different. Contingent fees depend on some action for them to get paid or for the size of the payment. So a contingent fee, you know, is sort of like, you know, unless this happens, you know, we don't get paid or we get paid a different amount. It's sort of like there's a contingent, well, like for instance, am I going to take an umbrella to work today? If it's raining, I'll take an umbrella to work. So taking an umbrella to work is contingent on it raining. If it's not raining, I don't take the umbrella. If it is raining, I do take the umbrella. Okay, so that is, you know, it's dependent on something else. So fees, it could be that you're doing some work for the client and they want to have it done by July 1st. And then if you get it done by July 1st, they give you a bonus. Okay, it's contingent on getting it done by July 1st, then you get this bonus of $5,000 or whatever it is. So contingent fees are dependent on something else. They're depending on something else, they're not a flat fee. It's not, hey, it's 16,000, that's the price. It's dependent on something else. So there are three main areas that you can't do this. Okay, so let me write this in. Contingent fees are not allowed for, okay. Okay, contingent fees are not allowed for, first, audits or other attestations. An example of that would be, you know, can you take a bonus for a clean opinion? Okay, so they're not allowed for that. So you cannot have a contingent fee dependent on the audit opinion. So you may have a client, you say, okay, the audit is 75,000, and they say, well, I tell you what, if we get a clean audit, I'll give you 80,000 if we get a clean audit. You can't take that. You can take the 75,000, the flat fee that you quoted them, but you cannot take the extra 5,000 because that is contingent on them getting a clean audit. Your independence would be compromised in that situation. Okay. Second, tax returns. An example of this. Our fee is 20% of your refund. So, and this one's kind of funny, so you say to your client, okay, you don't have to pay me anything up front, but whatever your refund is, 20% of the refund, that's going to be our fee. So it's dependent on the refund. Now, there's a problem with that. And that is that the more you increase that refund, even if it's illegally, then it'll increase your fee. Now, do people do that? Yes. See, tax firms do it all the time. CPAs cannot. So a CPA firm cannot have a contingent fee for tax returns. You can charge them a flat fee. Say, okay, yeah, we'll do your taxes. It'll be $110. That's fine. But you can't have it say it's dependent on, say, your refund or something like that, as far as getting you a fee. Again, this is one of those things that is specific to CPA firms and CPAs in general. You can actually lose your license for doing that. And there actually has been a development in this, and that is, in the past, there were people who were CPAs who had non-CPAs working for them and would charge these fees. The new rules are, you can't charge it for a contingent fee, or anyone that's working as a contractor or as a employee of yours cannot charge a contingent fee. So they've kind of closed that up a little bit, saying, look, you can't do it, and you can't hire other people, who aren't CPAs. If they're a contractor to you, or if they're an employee, then they cannot charge a contingent fee either. So it's kind of that came out the last couple of years, I think, but it's fairly new. So tax returns, you cannot do it. If you're not a CPA, can you do it? Yes. If you're a CPA, no. And the last one is I haven't talked about compilations. Compilations that are used for financing. And I have not talked about what a compilation is. I haven't talked about it, well, because I don't know. No, actually, I do know about it. Okay, a compilation compilation engagement takes the client's records and creates financial statements. There is no assurance given for these. You're simply taking their information. There's no assurance given for a compilation. It's not a attestation. Let me write that in. Okay, so far you say, okay, well, what's the problem here? So basically, what a compilation is, let's say that you have someone who runs a photography studio, and they just want to have financial statements. They go, hey, look, I don't know how much money I'm making or losing or whatever. Can I give you my checkbook and all the receipts and all this kind of stuff? And you make financial statements for it. You say, sure. All you're doing is making financial statements. You're not checking to see if these are all correct. You're simply taking what they give you and making financial statements for it, okay? Now, you cannot take a contingent on, for instance, getting financing either from a bank, a loan, or investors based on that compilation. So you do this compilation for somebody, a photography studio, and they say, well, we're trying to get a loan from the bank for $15,000, and if we get the loan, we'll give you an extra $5,000. You can't take it because again, it's your independence. You would be inclined to make them look more profitable than they are, so that they would get the loan, so that you would get a larger fee. And in both those situations, for the tax return and for the compilation, the people who are really on the hook for those are the client. If you make out a tax return that's not correct, the person who's, the people who are really going to pay for this are going to be the clients, because they're required to pay their taxes and whatever, and whoever prepared them, while they may have some liability, it's mostly on the client. And the same thing here, if you're cooking the books and they give those to the bank to get the loan, they're giving fraudulent financial statements to the bank. Okay, they're going to be on the hook for that. You might also be, but they're definitely going to be on the hook for that. They're the one that presented it. They're the ones that gave to the bank. So compilations, if you can't have a contingent fee if the compilation there's a contingent based on investors or or financing of some sort from the bank. Some kind of financing. Give an example. The one I just gave you. Now, you can, for all of these, you can charge a flat fee. There's nothing wrong with charging a flat fee for any of these. Okay. So compilation, you can charge them, yeah, I'll do a compilation for you. It's going to cost $200. That's fine. But you cannot have a contingent on it that if it's approved for a loan or for investors or whatever, that it gets paid. So compilations are kind of funny that they're actually not, there's no assurance given on them. You didn't audit anything. And by the way, it's one of those services that you can do because there's no assurance given. You can do this for family, friends, relatives. If you have a spouse that has a photography studio, can you do their financial statements? Absolutely. You can't do an audit on them, but you can compile the financial statements. There's nothing wrong with doing that. So compilations are no assurance is given on them, And because no assurance is given on, independence isn't required. So you can do the financial statements for your kids, your parents, there's no assurance given to them. You cannot do them if there's a fee based on some type of financing, either from the bank or from outside investors or something like that. You still charge them a fee. Although, if you want to know, one of the only things that's really a drag about being an accountant, is that people bring you their tax returns. Everybody brings you their tax returns. I do like 10 family members' tax returns every year. So that's the only drag about being an accountant, is that you're on the hook for that, but it's not that big a deal usually. Okay, tax discreditable. There are a few of them. I'll give you the ones that they kind of test on, because they're testing on more. One of the acts discreditable is revealing, but let's see. Spelled it wrong. No, I don't want to be reveling. How do you spell revealing? 2 L's? Okay. Revealing. I don't know if that's the right one or not. Anyway, revealing CPA exam questions is an act discreditable. It's actually illegal in a lot of states. So there's nothing wrong with discussing what was covered on the CPA exam. So you might say, okay, yeah, the CPA exam, they covered, leases were a big thing on the CPA exam. In general terms, you can cover it, but as far as specific questions, it's a no-no. You cannot tell specific questions, and you can't solicit for specific questions. So I'll never ask you, well, do you remember any of the exact questions that were on the CPA exam when you took it? I'll never ask you that, because it's discreditable, and it also would be asking you to do something discreditable. So you cannot reveal CPA questions. That's one of them. Not filing a tax return. You can lose your license if you don't file a tax return. 3, not cooperating with a subsequent auditor. So someone else comes to do an audit, for whatever reason, your client changes to a different auditor, and you're not cooperating with them. Generally, you're required to cooperate with them. If they haven't paid their bill, then then you don't have to. But if the client has paid their bill, you are required to work with the incoming successor auditor. Now, that successor auditor, it doesn't mean you have to work for free for that successor auditor. So you can charge a normal fee. So if they say, okay, we want these documents, you say, okay, well it's $1 a page. We had to go out and dig them and make copies of them and give them to you. There's nothing wrong with charging a normal fee for it, but you are required to cooperate with them. And the whole idea behind that is that it's a better way for auditors to understand the clients. And we'll get more into that in the next chapter, chapter 6. Okay, man, this is taking a long time. How many more are there? Oh boy. Okay. Referral fees. Okay, referral fees are not allowed for audit or attest engagements. So if you're doing the audit, you cannot charge a referral fee. You may have a client that says, what kind of insurance should I get? You have something worked out with an insurance company that, to send clients that you can't do it if they're an audit, if it's an audit or a testing engagement. So not allowed for audits or test engagements. Oh, let me change this. Referral fees are allowed for non-attest engagements if the fee is disclosed to the client. Okay, so let's say you're doing somebody's taxes. That's not an audit. So let's say you're doing not that. Let's say you're doing a tax return for somebody, and they say, I need to get insurance. Who do I go to? You say, well, okay, this is the insurance company that I recommend, and then you'll sell you. Okay, but I got to tell you, I do get a fee for referring you there. I get a $20 fee or something for referring you to Jim's insurance agent or whatever it is. So if it's not a non-attest engagement, if it's doing something else, taxes or something else, you can charge a referral fee, or you can accept a referral fee, but only if you disclose it and disclose exactly what it is to the client. So you can't charge it for if they're doing an audit. You can't you can't have any referral fees. So no referral fees if it's an audit engagement. It is allowed if it's not an audit or a test engagement. It is allowed as long as you tell the client exactly what the fee is. So it is allowed if it's not for an audit or a test, and it's yeah. So if it's not a test, it's allowed as long as you disclose it. Okay. Whew. CPA is an advisor. Okay, the CPA has a duty to their client and to the public. A CPA firm has a duty to their client and the public. A CPA cannot be associated with a tax return with questionable amounts. Okay, so if a client gives to you information that is obviously not right or is questionable, you need to dig deeper and see where they got those numbers from. And if you can't do it, then you cannot do the tax return. So, and that's part of the duty to the public. So yeah, you have duty to the client, but if they're doing a tax return, now normally on tax returns, tax returns are not audits. Tax returns are not audits. So generally speaking, if someone hands you the information, you put that into their tax return and that's it. But if it's obviously that these are questionable amounts, a CPA cannot be associated with it. And that's part of your duty to the public. Any question on that? So yeah, you can do tax return, you can, charge a flat fee, can't charge a contingent fee, charge a flat fee, but then you can also, you also are required to at least look at the numbers and see if they're reasonable. And if they're not reasonable, you can ask for additional information to see, where these numbers came from. For instance, they may have very high expenses, trying to make their business look unprofitable for taxes. These are just kind of some of the things that you might want to look into to see if especially if it looks like it's unreasonable. Actually, if you do the tax return software, it does the same thing. It'll say, okay, this is going to get kicked out for an audit because you got way too much in business expenses for somebody running a flower shop or whatever it is. I almost quit the Zoom meeting. Let's not do that. All right. Okay. This is a very important document. This comes out of your book. These are non-attest services for audit clients. So notice these are non-attest services that are be doing for audit clients. So they are auditors. You're their auditor. If you're not their auditor, these rules don't apply. So these rules on whatever, I don't know if it's still page 9 or not. These rules anyway are only for if you're doing the audit. So if it's an audit client, there are some things that are prohibited. There's some things that are prohibited for issuers and non-issuers. Okay, I can tell you right away that the issuers are held to a much higher standard. The issuers are really kind of buckled down to, hey, you get to do the audit, and that's kind of it. So going through these, non-attest services. So we're looking at, are these services allowed for audit clients? Bookkeeping. PCAOB says no. AICPA says yes. So you could actually do bookkeeping for your client. Now, you generally have to have management approval over the any journal entries you make. So if you make a journal entry, you gotta get management to approve it. But yes, you're allowed to do it. Financial accounting system installation. No. Oops, publicly traded is no. You'll find most of these are going to be no. Financial accounting, or excuse me, ASCP, I don't have that on here. Hold on a second. My fantastic thing is lacking. This first one, this is for issuers. This one over here is for non-issuers. Okay, so you are allowed to install a the financial accounting system. If you are a non-issuer, this one you're going to have to use a standard off the shelf, basically financial system, but you can install it. By the way, this was a huge thing that almost all CPA firms would also install a company's financial and or accounting system before the Sarbanes-Oxley Act. So this was an absolute common thing. When a company needed to upgrade its accounting system, hey, call our auditors. The auditors will install it. Publicly traded companies, it's a no-no now. You can't do that. Non-publicly traded companies, as long as it's something off the shelf like QuickBooks or something like that, you can install it. So, yeah, for publicly traded companies, it was very common, almost 100%, and now it's prohibited. By the way, one thing you're going to find that is a thread between both of for non-issuers and issuers is you cannot do management duties. If it's a management decision, you cannot do it. Okay, appraisals or valuations. No. And this one is usually no, unless there is completely unbiased, there's no judgment. I'm going to change my answer here today. Yes, if there's no judgment call. So let me change this. In other words, if it's objective. For instance, if there's a market price for stock at the year end, you can do that valuation because it's an objective measure. Okay, whatever the stock was on the stock exchange at year end, that's it. So if it's objective, you can do it. If it's subjective, how long is it going to last and all that kind of stuff, then it's a no. Internal audit functions for the client. No. It's kind of amazing that if this has ever been done, but the reason I say that is it's so much cheaper to have hire people to be internal audit. Internal audit functions for the client. It's yes if but the client always has the managerial. You can do the audits, objective audits, but you cannot make decisions. Human resource recommendations, generally no. And generally yes. Now you can make recommendations, you cannot actually make the decisions, but you can do the recommendations. Investment services, no. Actually, I'm going to put this down here. I'll say yes, but it's only for general investing, not for specific stocks or bonds or anything like that. So only for general, like allocations, how much do you have in stocks, how much do you have in bonds, that sort of thing. You cannot tell them, buy, whatever, buy Microsoft stock. Legal services, not related to auditing, no. This is a funny one. It's yes, but there are no rules that will actually tell you it's okay. So that's kind of a weird one. The AICPA actually does not put any rules on non-audit legal engagements. So by default, it's okay because they don't have any rules against it. but they also don't have any rules for it, and they don't have, generally they don't have any standards for legal advice either. The idea is it probably comes from a lawyer. Common tax planning issues. Yes for both of these. So common tax planning issues. So if it's a common thing, that is well known or whatever, you can tell your client, oh, you should do this. You should buy this at year end, or whatever. So usually the common tax issues, there's no problem. And by the way, a lot of times those are just things that go on the financial statements anyways. Telling your client what the tax ramifications are is not that, you're not actually changing the rules for common tax issues. Now, unusual or aggressive tax issues. This is a no for both. And the rule here is auditors cannot be an advocate for the client. You cannot say, oh, this is a good client. And that's basically what you have to do if you are going to court and arguing their position. You are advocating for the client. So they cannot be an advocate for the client. Individual tax services for officers. No. And this was very common. They used to have, if whoever's doing your audit would also do the tax returns for the upper management. And it was almost like a badge of, hey, I've arrived if the auditors are doing your tax return. It's not allowed for issuers, for public trade companies. It is allowed for, non-public trade companies. And a lot of times, by the way, non-issuers, the owners and the company are kind of one and the same, or the business are one and the same. So a lot of times it makes sense to do the tax return right along with it, because a lot of times it's the owner. All right, let's take longer than I thought. Okay, let me see here. I'm going to skip this. I'm going to skip this for a reason. It's not here. I'll tell you generally what it is. This kind of goes back to the covered member thing. International standards. International standards are much weaker than US standards. And they only have material financial interests are prohibited. So all that covered member stuff that we talked about for the US standards, for the international standards, they only look at material investments. So international standards, if you're doing an international standard audit of IBM, can you own IBM stock? Yes, as long as it's not material. Now, I think I mentioned, I don't know if I did or not, but the international standards are causing real problems now, because there's tons of bad things happening because of the auditors having investments in clients. But in the US, it's if you have one share, you're out. International standards say, okay, you can have 5 shares, you can have 10, when it becomes material, which is a judgment call, then it's a no-no. But basically, it's only those things that are material. Are you prohibited for? And again, that's a judgment call. US standards, there's no judgment call if it's direct. Direct, no. Okay, let's let's stop there. I'm not going to cover this. You can read through it. But yeah, another reason why I'm not going through it is the AICPA has made a statement that the CPA exam will no longer focus on differences between international standards and the AICPA standards. The reason is, hey, we're just testing on the AICPA standards. If you want to go learn about the other standards, you go learn about the other standards. But we're just going to focus on ours, whatever ours are. So they really don't do the contrast and compare thing that they used to do in the past. They're kind of trying to get away from that. Okay, so let's save that. We can turn that in. So our last thing was that chart where you can't do anything basically for issuers, but you can do a lot of things if they're not issuers. Okay, and when we come back, we'll go into the monetary unit sampling. And we'll do this when we come back. Okay, so this will be back at, oh man, it's late. 7:19. Okay, and we'll do number 6. Okay. Okay, so we're gonna do another one of these. This the last one? Yeah, okay. We'll do this one. Monetary unit sampling. And just kind of refresh your memory, we take everything, we split it up into intervals, then we take one item for each interval. So you take one item that's going to represent that entire interval, and that's what we're doing for monetary unit sampling. Now, that interval is important because for what we're doing, if somebody tries to overstate something, it's more likely going to be caught because it's going to cross that interval. So it's really good at finding overstatements. And the more that somebody makes something an overstatement, the more likely it's going to get caught. At a certain point, if they make it bigger than the interval itself, it's 100% sure it'll get caught. So that's why we do this method, but it's good for overstatements. If people try to increase, the size of their inflating their whatever it is more likely to get caught. Okay, so let's look at this first one. Okay, number one here is a little bit unusual. And what is unusual about the first one? So here's the audit. We go out, we look at this one, we say it's worth 5,200. We look at the book, and the book says 5,000. For this method, what is unusual about this one?
It's understated.
We are not supposed to find these. So when we do find them, I get into two words. It's understated. So this one is one that we should not find. In fact, so much so that if we do find one, we ignore it. As an auditor, I can tell you that bugs that bugs me. You find an error, and you say, "What do you do with that error?" Well, I ignored it. That doesn't seem like a good thing to do. Well, that's the method. It's only good. This method is only good for overstatements. It's not good for understatements, and when we find them, we ignore them. So this first one is really not any, and is it included in the incremental allowance? No, it's not an error at all according to this method. Okay, the next one is kind of a run-of-the-mill one. This is normally how we see these. Okay, so time for calculator. Hey, I don't have my phone with me. All right, got my little miniature calculator. Put it on that one in my head, I think. So the projected amount here is 75,000 for that. That's the projected value of it. So the projected misstatement is 25,000. Now, you'll notice that the book value of this item is less than the interval. So there could be more things wrong in that interval, and the fact that there already was one misstatement means that it means it's more likely that there will be more. The appearance of one item in the sample is misstated means that it is more likely that others will be misstated too, because now you know it's a possibility. So is this going to be included in the incremental allowance?
Yes.
So they're going to be included in the incremental allowance because there could be more things wrong in that interval. And two, the size of the misstatement matters. You know, if it's off by $25, it's different than if it's off by $25,000. Okay, number 3 is an odd duck. What's strange about number 3?
The book value is greater than the interval.
Yep. You'll notice that this is bigger than the interval. You know, what was the percentage chance of this one being picked? 100%. It had to be picked. It went more than the interval. It might cross 2 intervals. It's possible it crossed 2 intervals, but it definitely crossed 1. So I can tell you this, there won't be anything in the incremental allowance for this one because nothing else could go wrong. It's covered the entire interval, 108,000. There's nothing left in that interval that could go wrong. It's completely covered in there and then some. Okay, so what do we do with this one? We fall back to the actual misstatement. So we're going to take 108,000 the wrong thing in there. Hold on. 108,000 minus 95,000 equals 13,000. And this will be the actual loss or actual misstatement. So once it covers the entire interval, we don't do the ratio thing. We stop right there. We say, okay, we're just going to take the actual loss of 13,000. That's going to be our rejected misstatement. Now, nothing else could go wrong in that nothing else could go wrong in that interval. So we don't have it. There's not going to be an incremental allowance because there's nothing left in there. And actually, you know, I'm going to talk about this more specifically. In this monetary unit sampling, how does it get its name, monetary unit? Monetary unit, well, we used to call it dollar value sampling, in that each dollar is considered an item. Each dollar is considered an item. Each dollar has an equal chance of being picked, the dollar itself. Now, if our entire sample is, in this case, 100,000, and we picked a sample of 108,000, we've picked everything in that sample. You know, each one of those monetary units, this could be in euros, it could be in yen, it could be in whatever, but every single item, every single monetary unit, in this case dollars, every single dollar in there is considered to be an item. And if you picked all of those items, it's no longer a sample. You picked 100% of it, and you know exactly what it's misstated by. It's misstated in this case by 13,000. So monetary unit is really saying that each dollar, in our case, is considered a unit. It's considered a sample, part of the sample. I think I told you that's why there's no standard deviation on these. It's just a big long list of ones. You know, so it's there is no standard deviation because if everything is a 1, there's no deviation. Kind of a weird sampling thing, but it actually works very well. Okay, so these together will be the rejected misstatement of 38,000. And this is our best estimate of what this is off by. This is our best estimate. Oops. Now, because it's a sample, though, it could be off by more. So we think it's off by 38,000. However, it's a sample. So it could be off by more, and we're going to calculate the basic precision and the incremental allowance to determine that. Okay. Basic precision. I'm going to do the walk of shame all the way down here to get the basic precision formula. Whoa. Okay. Basic precision got a lot bigger. What size are these? 11. Okay. What idiot made this handy? Okay, so basic precision equals our interval times reliability factor. Okay, let's take the easy one. What's the interval?
100,000.
So our interval is 100,000, and we're going to multiply that times the reliability factor. Reliability factor. The reliability factor. Be careful with this because the risk of incorrect acceptance is important here. So we're going to go to 10%. So we're going here. And we use the row 0 for it. And if you're wondering why we use row 0, this is the incremental fact. This is the amount that it could be off by if there were no misstatements. Even if there were no misstatements, our sample could be off. So this is the, even if we didn't have any statements, we would have this 2.31 times, where is it? $231,000. So even if we didn't have any errors, any overstatements, it could still be off by 231,000. Okay, now for the goofy one. Incremental allowance. Now, when we come up here, we can see how many items for the incremental allowance do we need?
One.
Yeah, this is the only one that we have. This one isn't going to be in the incremental allowance because it can't be any worse. There's 100,000 items in the sample. We picked more than 100,000 items in the sample, so it can't be any worse. This one, things could be worse. And it depends on how big it is too. So, okay, so we only need to get one of these. So when we come down here, we're going to use the increments from 1 overstatement to 0. So 3 point. Okay, so these two, let me. -1. .58. And don't forget this -1 thing. If anyone makes a mistake on here, it's almost always this. So we have to minus those, but then also the minus the 1. Okay, the first largest misstatement. We only have one misstatement that we're going to put in here, so that'll be the 25,000. So the incremental allowance is is that right? 14,500. Is that what you guys got? Hopefully. Okay. I think that's right, isn't it? Yes, it is. Okay, so 14,500. So this is our incremental allowance. And this is the additional amount that says, okay, well, we know we know that we had some errors. And so because we had errors, these things could be off by even more. It becomes more likely that there are errors. And also, it matters how big it is. You know, if this is 25,000, it comes out to 14,500. If this was a different number, if this was 10,000, it would be less, right? So it matters how big the misstatement is. Okay, and we roll all these together. Copy the whole thing down here and then clean it up. And we go to the next page. And this will be our upper limit on the misstatement. This is what we'll use to see whether we will accept it or not. Okay, what did that comes out to? $283,500. So this would be our upper limit on the misstatement. Our best estimate is that it's off by 38,000, but this is a sample, so it could also be off by up to 283,000, and that's at 10%. Okay, so how much was in this account? Okay, so the book value of accounts receivable was 2 million. This is probably material. It's a judgment call, but I would have to think that it would be material. Maybe not, I don't know. That depends, I guess, on how big the financial statements are. But it's off by up to 283,000, not 2 million. That's more than 10%. 14% or something. So probably material, but CPA exam, they will not ask you if it's material. They don't ask you to make judgment calls because it is judgment. You know, you could put whatever your judgment was. They'd have to accept it. Okay. All right, so at the very end here, and this is one of the things they do test on the CPA exam, the advantages and disadvantages of the different methods. So advantages of monetary unit sampling, and there are actually quite a few. First one is there's a smaller sample size. Automatically stratifies sample, and I'll talk about that in a second. Well, let's tell you about right now. Bigger items are more likely to be picked. Because they're more likely to cross the interval. And at some point, if they get big enough, it's 100% sure they're going to cross the interval. And generally easier to use in classical sampling. Let me put one more. Actually, no, the stratification one takes care of it. Never mind. So it's easier to use in classical sampling. It's much quicker to pick the sample. It's much quicker to find the sample size. And oftentimes, if there aren't too many misstatements, a smaller sample size. And this is one of the things as an auditor you will find almost always when I was doing auditing, if I went through a sample, it went one of two ways. Either everything was perfect, and you go through there and you go, okay, I've already done, 58 of these, and I got to do another 62 of them or whatever. We already know where it's going. There's nothing wrong, right? So that's, usually that's the case, or it's a mess. Wait, okay, I've gone through 8 items and 4 of them are bad. Okay, you know where this is going. So one of the things is, especially with those things you don't expect the errors to be, is that you can pick a smaller sample if there is less likely that there's going to be errors for the probably proportional size. So instead of picking 120 items, maybe you pick 50, depending on your parameters for picking the sample size. So it reduces it, and testing is where a lot of the time is spent and a lot of the a lot of the effort. And if you can cut it down and make it more efficient, it's better for you, it's better for the client. Okay, disadvantages. Cannot be used for understatements. That's the biggest one. If we have understatements, they can't be used. It ignores them. Another one is the sample size is not easily expanded. If you do run into an error, okay, so let's say that you run into an error, and let's say classical sampling. If you run into error in classical sampling, you go, okay, I want to be more sure. Maybe we did this at the 10% level. I tell you what, let's bump it up to the 5% level and see what we get. We'll take more items. We'll go randomly pick some more items, throw them into the hopper, and find, get an average and become more sure. Because at 10%, it said there might be a problem. The bigger the sample, the less likely it is that you're going to have a mismatch between the actual and your sample. Okay, so you just go pick some more items. Probably proportional size has a real problem with that. If you change the percentage from, say, 10% to 5%, remember that changes your sample size, that changes the interval, it changes the items that you pick. So you might, you could end up with completely different, and you probably would end up with completely different sample if you were to do the probably proportional size again. What a lot of times people do is when the probably proportional size says that there's a problem, they switch over to classical sampling, because to become more sure of it, it's a lot of times more efficient just to switch over to a different classical sampling. Okay, so it's not for everything. When I was going through school, they said this was the greatest thing ever, and you should use it all the time whenever you can. Nowadays they're a little more reserved. They said if there's overstatements and there's very few, the occurrence of misstatement is low, this is a good one to use. Otherwise, classical sampling. Okay, classical sampling. If there's errors in it, classical sampling is fine with that. If they have a high occurrence of errors, it says that's okay. If there's negative items, it's okay with that too. Throw them in. It's a negative, okay, it's not a positive five, maybe you have a client, they have a client on the books that has a book balance of $300, and you find out that they return some stuff and they actually have a credit of $80. It's a negative accounts receivable. It's fine with that. Throw it in. It'll become part of it. Big one. It can be used for understatements or overstatements. So if you are unsure, you got an account and you're not sure if they're going to try to overstate it or understate it, this is the method to use. Classical sampling. And sample size can be easily expanded. Estimated standard deviation must be calculated to determine the sample size. This is, we didn't do this. We didn't do it for a reason. One reason is that, first of all, in regular statistics class, you could probably do this. But the CPA exam has never, to my knowledge, tested on choosing the sample size for a classical sampling. It's pretty involved. You can look at it in the book. But they've never actually asked for that. You basically have to do some kind of a pre-sample or even use the year before test as a for the standard deviation. You have to find the standard deviation before you can find the sample size that you need to take, which means either you have to go out and take a pre-sample or somehow use a sample, say from last year or something, to get an estimate of what the standard deviation is. So it's your first year on the audit, you got to do a pre-sample. And stratification, we're actually going to talk more about this in the next handout, but stratification is testing more larger items and less small items. Okay, and this one is important. The auditing standards do not advocate one over the other. They say wherever it's appropriate. Back in my day, they said, do probability proportional size whenever you can. Nowadays, they say, no, whatever fits the sample. And certainly if you're looking at understatements, you're going to want to do classical sampling. Hey, we're done. I didn't think we were going to get done with this. Okay, let's turn both of these in. So we finished monetary unit sampling. We also finished the ethics handout. I'm going to put in finish as if we planned this. Yeah, I planned that we would finish that. So I boldly said we're going to finish both of them. As far as the multiple choice, I think it's too late. We'll do those next class. We'll do the multiple choice for chapter 3 ethics, and then we will, we're going to go into a new sampling thing anyways. So I've had enough fun for tonight. Have you guys had enough fun? I can tell by the looks on your faces that you've had enough fun. So, so turn in the chapter 3 handout and the monetary unit sampling. I gotta make sure I have those in there. Well, I'll check on that later. Okay, so monetary unit handout can get turned into chapter 3 ethics, and then next week we'll do the multiple choice for chapter 3 ethics and have the exam. We'll send it out next week. Yes. Sorry. I couldn't get to the mute in time, but you didn't see me sneeze. Okay, so turn those in, and I will see you next week, and we will have the multiple choice questions for chapter 3, and then we'll also do we'll start in on chapter 6 and sampling overview. Any questions? Okay, have a good night, and I apologize for sneezing at you guys. I didn't mean to.
Thank you.
Thank you, Professor. Have a good night.
Have a good one.
Yep.